Welcome, everyone. My name is Elizabeth Warner. Thank you for joining us today for our webinar, Affordable Care Act, What You Need to Know in 2015. Before we get started, there are just a couple of housekeeping items. First, this webinar will be in a listen-only mode to cut down on background noise. And second, we will answer all questions at the end of the presentation during our Q&A session. You can ask questions throughout the webinar using the question function of your webinar console in the lower right-hand corner of your screen. And finally, we will be sending you a replay link to the webinar recording in the next day or two. To kick things off, I'd like to hand it over to Eileen Covey, Manager of Financial Analysis here at Edison Partners.
Thank you, Elizabeth. Basically, at last year's CFO event, we instituted an Around the Horn forum. Some of the attendees on the phone attended this event, and we basically opened up the floor for a variety of topics, one of which was healthcare reform. Based on the flow of conversation during the discussion, we realized we could have done an entire session on healthcare alone and asked the attendees with a show of hands if they would be interested in a webinar to discuss healthcare reform in more detail. And 3/4 of the room raised their hand, which is what brought us here today. So I'd like to introduce our two guest speakers for today. We have Frasier Ives, a benefit compliance practice leader at Wells Fargo, and Joe Hall, Regional President at CheckpointHR. And without further ado, I'm going to hand it over to Frasier.
Thank you, and welcome, everyone. What we're going to try to do today, we know we have a wide variety of participants on today's webinar event. Some may have already spent a lot of time trying to understand healthcare reform. Others may have been trying to avoid it as long as they possibly can. And some may realize that it really doesn't apply to them due to their size. So what I'm going to try to do in my piece of the presentation is to talk very briefly about a basic overview of the ACA so you can understand the cyclical nature of the regulations that keep seemingly coming in waves. Then we're going to talk about some of the current challenges, where they stand in Congress and in the judiciary about certain challenges to the ACA. Then we're going to talk very briefly about some basics about pay or play and some basics about the Cadillac tax that's currently still scheduled to go into effect in 2018. And then we're going to talk go through about 5 items that are what we believe that all employers should be doing right now, either doing in 2014 or continuing to do in 2015, and help point out to you what some of your highest priorities should be in trying to bring you up to speed as to what you really need to know. Then I'll hand it off to Joe Hall. Joe will go back and repeat some of the basics of pay or play and what have you, because it's one of those topics that you have to hear it multiple times for it to really just start to sink in. And then more importantly, then Joe's going to talk about some real-life case studies that basically apply the theory to of applicable real-life situation and to bring it home, and also talk about some trends and some strategies that they are seeing in the marketplace. So with that, can we advance to the next slide? The way I like to frame up healthcare reform is I like to think of it as a series of 4 different tsunamis that are hitting employers. The first tsunami started in 2010, 2011, right after the law was passed, and it involved a series of required changes that occurred to all health insurance plans, whether they were individual plans or whether they were sponsored by an employer. There was a variety of things that the law basically were making fundamental changes as to what had to be included in certain types of insurance programs. For the most part, those changes have already been implemented, have already been factored into the pricing and the offerings that are available right now. And so for the most part, that tsunami is starting to kind of smooth out. On the heels of that tsunami, that first tsunami was the opening of the public marketplace exchanges in 2014, along with the first year that the individual mandate kicked in 2014, and now in 2015 is the opening of the employer mandates for some employers. And so the combination of the individual employer mandates and the opening of the public exchanges and the confusion about all of the nuances and the rules that kick in for an individual to determine are they subject to the mandate. If they don't have coverage, are they penalized? Or from an employer's perspective, what do we need to offer, if anything, to avoid potential penalty exposure? That's the tsunami that we're right in the middle of right now, okay? The third tsunami is a hidden tsunami that I don't think a lot of employers fully appreciate that, and that's these new information reporting obligations that are going to kick in starting with the 2015 calendar year, and that you're going to have to do some reporting in early 2016 with respect to the entire 2015 calendar year. As we'll talk about in a few minutes, the data feeds and the detail that has to be produced, pulled from different data systems to be able to be refigured and then to be redistributed to the participants, to your employees, and back to the government is sort of like a W-2 requirement on steroids. That's a brand new W-2 requirement, and a lot of employers just don't fully appreciate how difficult of a task it's going to be to get their systems in place to be able to comply with this information reporting obligation in early 16 with respect to the 2015 calendar year. And the last tsunami is the Cadillac tax. It's scheduled to go into effect in 2018 if it doesn't get changed or delayed. And the problem with the Cadillac tax, as we'll see in a few minutes, is that it's not a question of if, it's a question of when. Just about every employer plan will eventually become subject to these additional excise taxes because the way the law is structured in this area, plans that are too generous and that provide too much benefits to employees will end up being subject to additional excise taxes that the employer will have to pay. And so dealing with that issue and dealing with the implications of that issue is the fourth big tsunami that employers are going to have to face. Next slide. But let's back up and talk for a second about all that you're hearing in the mass media these days is the various attacks against the healthcare reform law, and the fact that changes need to be made, but what sort of changes are realistic and what little changes are likely to occur. From our position at Wells Fargo Insurance Services, notwithstanding the fact that the Republicans control both houses of Congress right now, they do not have enough votes in the Senate to prevent a filibuster, nor do they have enough votes in either the House or the Senate to override a presidential veto. So for the most part, even though a lot of the Republicans in Congress are going to continue to press for different aspects of repeal and replace or to start to try to make changes with respect to different elements of the law, the chances of a wholesale replacement of the law or a repeal of the law, we think, are extremely remote because they just will not survive a presidential veto. Doesn't mean that attempts aren't going to be made, and there's going to be a lot of political fodder generated by the activities in this area. What's much more likely to occur, and we've already started to see this, is the Republicans reaching out across the aisle to try to build certain bipartisan support to go after very specific parts of the law. For example, the medical device manufacturer's excise tax, or the definition of full-time employee, trying to say, rather than using the 30-hour per week requirement, which we'll talk about in a minute, trying to push that back up to a 40-hour per week requirement, or possible changes to the Cadillac excise tax. In some of these areas, there is some degree of bipartisan support, but the trick is in addition to the bipartisan support, a lot of these elements in the law, if they are repealed, it's going to have an adverse impact on the budget. And so the sponsors of these bills are going to have to come up with replacement income to replace the revenue that these provisions were projected to generate. And so you're going to have to look for bipartisan support and revenue replacement, which is going to be difficult in a lot of situations to get a lot done with respect to the ACA, but certain nibbling around the edges is probably going to occur. Next slide. A huge issue that's on the table for 2015 is the King versus Burwell Supreme Court case. This is a case that's challenging the legality of the government of continuing to provide subsidy payments to individuals that obtain individual insurance coverage through federally facilitated marketplace exchanges. The way the law was set up and rolled out, the intention was that every individual state was going to set up their own separate marketplace exchange, and then they had a backup that if a state chose not to set up their exchange, then there would be a federal backup that would kick in and would allow the citizens in that state to continue to get access to exchange coverage, and if they satisfy a variety of eligibility requirements, be able to get access to subsidies to bring down the cost of that individual insurance. Well, the way the law was actually written was extremely ambiguous on this point, is one argument. The other argument is it was crystal clear what the law said, and the law indicates that these subsidies really were supposed to go in place only for state-operated exchanges, and so the IRS, trying to correct essentially a drafting error in the statute, issued regulations saying, oh, well, I'm sure Congress really meant that these subsidies were supposed to go to any public exchange, not just state-run exchanges. And that issue is going to be heard by the Supreme Court in March. Oral arguments are scheduled for March, and a decision is expected by sometime in June. If the government loses its argument, it's going to result eventually into probably the collapse of the individual insurance markets in those states that have not set up their own state exchange. From an employer's perspective, employers are going to basically not become subject to pay or play penalties, because the only way an employer can be subject to pay or pay penalties is if they have employees that go and get subsidized exchange coverage. And if they can't get the subsidies because those employees live in a state that has a federal exchange, then the condition precedent to trigger the penalties doesn't exist. But if the government loses its argument, there's going to be a tremendous amount of political pressure put on the states, because to try to convert as quickly as possible to a state exchange, because if they don't, then they're going to have large numbers of individuals in their state that are instantly going to go uninsured, because they're going to need those subsidies to be able to continue to afford to buy individual health insurance. Or another way this could play out would be, if the government loses this case, that it might bring the Democrats in the White House to the bargaining table with the Republicans to fashion some sort of a grand bargain with respect to health care reform, i.e., hey, if you eliminate this part of the law or that part of the law, then we will allow the subsidy, we will change the law to make it clear that these subsidies can continue to be paid to federally run exchanges. So very interesting court case that we all got to keep our eyes on this year. The key point, though, is don't wait and hope that that is going to be thrown out. You still need to probably be understanding and planning that, because you don't want to be caught with your pants down if the government does win, sort of like 3 years ago when unexpectedly the government won its original case about the individual mandate. Next slide. So what should employers be doing now? The first thing that I always try to make sure employers understand is you need to understand the pay or play rules at least at a somewhat intermediate level, and you got to ask yourself a couple of questions. The first one, are you an applicable large employer? Because the pay or play rules only apply to applicable large employers. And in a nutshell, that basically means you're going to look back to the prior calendar year and see, did you have 50 or more quote-unquote regular employees and full-time equivalents, taking all your other employees, adding all their hours together and dividing by 120 hours to convert them into full-time equivalents. Did you have the sum of those two numbers, was that more than 50 full-time and full-time equivalents in the prior calendar year? If so, you're going to be an applicable large employer that potentially subjects you to some pay or play penalty exposure. One of the problems in this area is you need to understand how the ACA defines full-time. That is, the simple answer is they look to somebody who on average is working 30 or more hours per week, averaged over a month, but the full flushing out of that concept of the ACA definition of full-time is extremely complicated based upon which measurement approach that you're using and some of the nuances of those rules. Another key thing to understand about the pay or play rules is they imposed when they reissued the pay or play and finalized the pay or play regulations early in 2014, they included a number of transition relief provisions, the most important of which is for certain mid-size employers. Those are employers that have between 50 and 99 full-time or full-time equivalent employees. If you set aside certain conditions, you don't have to worry about pay or play until 2016, as opposed to worrying about it in 2015. Another key transition relief provision applied to certain, but not all, non-calendar year plans. So if you're an employer that that operates your group health plan not on a calendar year basis, but let's say on a July 1st, fiscal year basis, then if you set aside certain conditions, you don't have to worry about pay or play until the first day of the first plan year that begins in 2015. And there's also a variety of other partial transition relief rules that can kick in different situations. Next slide. The next big issue that you need to understand is if you are an ALE, an applicable large employer, then you need to identify and quantify what your financial exposures are. That's going to involve determining how are you going to measure your full-time employees, which in turn is going to be a function of what's the composition of your employees. Do you have a very stable workforce that's almost all salary employees that all clearly work more than 30 hours per week? Or do you have in your workforce a significant percentage of your workforce whose hours bounce and vary dramatically, that may bounce over and under 30 hours per week, or a lot of seasonal employees? Those type of demographic issues are going to drive you to determining which one of the two permissible measurement period strategies you're going to need to implement to be able to determine who is a full-time employee. You're going to need to review your systems to be able to figure out, are you tracking hours and the measurement periods correctly, and are you being able to pull the right data that you need for the information reporting rules that we'll talk about in a minute. You need to determine, are your existing plans affordable as defined by the ACA, and are they acceptable as defined by the ACA? In other words, do they provide minimum value to your employees? There's a variety of new ACA-related taxes and fees that may kick in that you need to understand the mechanics of how they're being paid. And then you probably need to run some sort of an analysis to see what your exposure is under the pay or play rules and what your exposure is under the Cadillac tax rules if the law stays the same. Next slide. Next slide, please. Very briefly, this is an overview of the pay or play rules. Starting on the left, they only apply if you're an applicable large employer, 50 or more full-time or full-time equivalent employees, determined on an Internal Revenue Code controlled group basis. And then you're going to be, if you're an ALE, you potentially can be subject to either an A penalty, which is described on top, or a B penalty that's described on the bottom. The A penalty says if you're an ALE and you don't provide some sort of group health insurance, that's what MEC is, minimum essential coverage. It's essentially a group health plan that's not accepted benefits. If you don't provide some sort of group health coverage to substantially all of your full-time employees and dependents, then you as an employer are going to be subject to a very onerous excise tax if any of your full-time employees go and get federally subsidized exchange coverage. On an annualized basis, that excise tax equals to $2,000 in this COLA times the total number of full-time employees in your workforce minus a offset figure. For 2015, it's 80, and you can reduce your head count by 80. After 2015, you can reduce your head count by the first 30 full-time employees. Notice this penalty only applies to full-time employees, not to your FTEs, your full-time equivalents. Full-time equivalents only come into play to determining whether or not you're an ALE or not. They do not come into play in determining whether or not you've got penalty exposure. Even if you offer some sort of coverage to substantially all of your full-time employees and dependents, then you still could potentially be subject to some penalties, and that's described on the bottom of the slide. And that's if what you offer to your employees is not acceptable or affordable. Those are defined terms, or concepts under the ACA. And if you still are offering something that's not acceptable and affordable, then for each individual full-time employee that is still able to go and get federally subsidized exchange coverage, then you as an employer are going to be subject to an annualized non-deductible excise tax equal to $3,000. And so the bottom penalty is a per participant penalty if you leave the door cracked open. The top penalty, the A penalty, is an entire workforce penalty. And so what I usually try to tell employers is, it may not be the worst thing in the world to allow a few people, a few employees, to slip off the back of the bus and pay the per participant penalty, but you don't want to drive your entire bus into the ditch and become subject to the A penalties. Because we've done modeling over 900 employers we've done modeling on, and once you get above about 100, 120, 25 or so employees, it rarely, if ever, makes economic sense from the employer's perspective when you take into account all the tax implications and all of the potential replacement income implications to terminate your plan completely and not offer anything. But on the other hand, if you are a smaller employer, if you're clearly less than 50 employees, then you're not even worried about pay or play, so you could drop your plan if you wanted to and not be subject to any penalties. If you're between 50 and about 150, you really kind of need to do the math and try to figure out what the strategy is and what you need to attract and retain your workforce. Next slide. This slide kind of flushes out some of the additional definitions that are part of the pay or play concept. I'm not going to go into any great detail on those, but leave them for your reading. But essentially what they're asking employers to do is offer accessible coverage, meaning offering something to all employers over 30 hours per week. Make sure it's acceptable. That means it has at least a 60% minimum value. That coverage is affordable. Affordable means just looking at employee-only contribution rates, does that employee have to pay more than 9.5% of their household income to obtain employee-only coverage? Note that employers do not know their employees' household incomes. They just know how much they pay that given employee. They don't know the spouse's income, for example. So they've laid out some safe harbor rules that employers can use. And then the last slide is about the subsidies. Not everybody's going to be eligible for subsidies. An individual has to have income between certain thresholds. It has to be in excess of 100% of the federal poverty line based on their household income size, but less than 400% of the federal poverty line. They're not going to be subject to a subsidy if their employer offers to them acceptable and affordable coverage, or even if that coverage is not acceptable or affordable, if the employee takes that coverage anyway, then they're not eligible for federal subsidies. And they're not eligible for federal subsidies if the individual is eligible for Medicare or Medicaid, and the eligibility for Medicaid is a huge issue in those states that have expanded their Medicaid program as allowed under the ACA, because it really reaches up much higher, up to 138% of the federal poverty level, for individuals that would be automatically eligible for Medicaid. Next slide. Here's a brief overview of the Cadillac tax. What it really does is it basically says that you look at the total cost of employer-provided health coverage that you're providing to each individual employee. And if the total cost, meaning both employer and employee contributions, in other words, COBRA rates or COBRA equivalent rates, if that value is in excess of certain thresholds, starting off at $10,200 for single coverage and $27,500 for all other non-single coverages, if the value of the coverage is over those thresholds, the excess over those thresholds is going to become subject to a non-deductible 40% excise tax. Now, those thresholds are indexed to inflation, but only to regular inflation, not to medical inflation. So, unless the grand experiment of the ACA does what the policymakers were hoping it would do, okay, which would be to start to tamp down medical inflation, then what we've seen over the last 10, 15 years is that medical inflation tends to trend at least 2 to 4% higher than general inflation. And if that continues to be the case, then most employer plans will hit those thresholds in 2018 or pretty close to 2018, regardless of how generous or how lean those plan designs are. Now, eventually, almost everybody's going to be over those thresholds, and to some extent, I think that's partly what they intended, because they believe that too much dollars, but otherwise would be taxable dollars that's being conveyed by the employer, transferred from the employer to the employees, is being denominated in tax-exempt health benefits as opposed to taxable compensation, and they want to put a cap on that so they can raise more revenue. Next slide. I'm not going to spend a whole lot of time on this one. This is, once you understand your ACA exposures, then you start analyzing your plan designs, your contribution strategies, your eligibility criteria, and to come up with an implementation and an employee communication strategy. This is a lot of what Joe's going to talk about in a few minutes. The only point that I would make here is watch out. There are a lot of too good to be true traps for the unwary out there, especially for smaller employers. And employee communications is going to be critical. One other point is just because the ACA defines full-time employees a certain way, it doesn't necessarily mean that you have to define eligibility for your plan that's 100% consistent with the ACA definition. So in some cases, it may not be the worst thing in the world to be overly generous and to cover certain part-time employees. On the flip side, it may not create too much of a financial exposure to you not to offer coverage to a small group of employees that would otherwise be defined as full-time under the ACA, but you just don't want to offer coverage to them. So even though you're leaving the door cracked open that they could possibly trigger a penalty against you, it may not be that bad to leave that door cracked. Next slide. The ACA information reporting rules are going to be a bear because they are going to be very similar to W-2 reporting, and everybody, whether you are offering insured or self-insured plans, are going to be subject, or whether you're an ALE or not an ALE, are going to be potentially subject to certain information reporting requirements. So, for example, next slide. There's one reporting requirement under 6055 that basically says any entity that provides any sort of minimum essential coverage is going to have to do certain information reporting to the government. And very specific data points have to be reported. So if you have an insured coverage, your carrier is going to handle this. But if you have a self-insured plan, you will have to handle this. Next slide. If you are an applicable large employer, you're going to have a separate reporting obligation. And you're going to have to report certain data elements to the IRS and to your participants, letting them know what sort of coverage did you offer. Why? Because the government needs the data to be able to enforce the pay or play rules and to determine who's eligible potentially for premium tax credits, the subsidies, if they go and get public marketplace exchange coverage. Next slide. This is a busy slide, but in one slide, if you follow, especially looking down the filing scenario column, you can understand what your obligations are going to be, depending upon whether or not you are a non-ALE, then you still have that 6055 reporting obligation. If you're self-insured, you as the employer have to file it. If you are fully insured, your carrier will generally have to, satisfy that requirement. If you are self-insured and an ALE, you're going to have, all ALEs will have a reporting requirement under 6056 and fill out parts 1 and part 2 of this 1095C form. If you're self-insured, you can continue to use that 1095C form and disclose to the government your actual coverage information using part 3. If you're insured, your carrier is going to be distributing that coverage information to your participants, but you still are going to have to be filing part 1 and part 2 of the 1095C form. So notice when the carriers are filing forms, it's the B forms. When it's the employer filing forms, it's the C forms. Very detailed, very complex instructions that you need to get your arms around. Next slide. Why? Because the data that you're going to need to be able to understand what has to be reported on those forms is potentially coming from multiple sources. And so you're going to have to pull data potentially from an HRIS system, payroll, spreadsheets, a bin admin system, repurpose that data, stir that data and combine it with all the ACA rules to figure out how are you going to administer your plan in terms of eligibility, and how are you going to repurpose that data to be able to populate the 6055 and the 6056 forms that you may be subject to. Getting those data feeds set up and getting an appropriate ACA management tool in place should be a key issue for CFOs and ID departments in 2015. Next slide. Next slide. And finally, the law is going to change, but it's no excuse to keep your head buried in the sand and hope that all this is going to go away. At the end of the day, employers are going to have to continue to figure out what sort of compliant health coverage, if any, they need to continue to offer to attract and retain the labor force that they need to be successful at a price point that they can afford. And I'll leave you with that, and then I'll hand it over to Joe.
Thank you, Frasier. You certainly live this every day, being in compliance. And in the interest of time, I know that you covered in greater detail than I probably would have gone into on a lot of the ACA penalties. And some of our slides will have duplication. So what we'll do here is focus on whatever the important components are, but I'm not going to spend a great deal of time on it, seeing that we've gotten tremendous detail and information from Frasier. So what instead I'm going to do is go talk a little bit about the payer play. But what my goal is today really is to bring to you some real-world examples. Our company is working with clients pretty much every day, from as small as 10, 20, 30 employees. And then we have quite a few in that middle range, the 51 to 99 that Frasier was talking about, and quite a few on the over 100. And I know our audience today is sort of a mixture of all three. So we're also going to, after we talk a little bit about the ACA rules, we're going to talk a little bit about how employers are attracting and retaining employees while trying to manage costs in a post-ACA world. We also want you to note that most large employers that are offering group health insurance today, they're compliant. If you're buying a fully insured plan from a carrier, the big carriers we all know, the Aetnas, the Oxfords, the Cignas, the Blue Cross Blue Shields, we don't know of any carrier that isn't giving a fully insured plan that meets the minimum essential coverage and value. So we're not having to spend a lot of time with them if they're currently offering plans. But the industries that are really facing a challenge here with compliance are more typically in retail, fast food, temporary agencies, because the temps don't usually get health care. And of course, any company with a lot of part-time or seasonal employees that bring what would be a small company over that 50 life threshold to be to have the ACA applicable. Next slide. So on this slide, we did cover this in quite detail with Frasier. We do know now that there's transitional relief for all those companies out there with a 50 to 99 size. You did get another year and really don't have to be compliant until 2016. And it's not January 1, 2016. It becomes effective at the time you renew your health plan. So if you renew in August of 2016, that's when you have to be compliant. And the minimum value, I don't know if people understand really what that is. It's basically saying that the plan you have must satisfy 60% of most medical expense, of the medical expenses on average for a standard population. Now that's the government's definition of that. And as Frasier mentioned, the 100 or more is in effect now. All the penalties are in effect now. But again, if you have over 100 and your renewal doesn't kick in until July, that is when you will have to become compliant. We know that the toughest part of this is the government's definition of a full-time employee. We have so many employers that really don't use 30 hours. They're at 35, 38, a lot of them are at 40. And one particular employer we know has part-timers, but they often go over 30 hours, and there's about 300 part-timers that this falls into. And when they come up for renewal this summer, they're very concerned about how they're going to stop these employees from going over the 30-hour mark. And they're having to look at all new time clocks and systems to not let them reach the 30 hours, because if they do, they're going to have to provide them health care. Next slide. The waiting period is one of the 4 key requirements that changed. This hit a lot of employers, because if you're a large employer, you don't always know if 90 days is enough to make an assessment of a new hire. You don't really want to offer a full benefit package to an employee, and have it be under 90 days and find out on the 91st day that this employee is not going to work out, and then you have to let them go, and you're offering COBRA, and it's a lot more administrative hassle. So that one was kind of tough. The minimum essential coverage we covered, minimum value we covered, and affordable coverage we will go into in a little more detail. Let's go to the next slide. Now this particular slide, we have saw a version that Frasier gave. This was a very common slide that was sent around when the first word pay or play was mentioned, 2-3 years ago. And it really does just take you through the example. Now, we did find, again, most of our 15-plus employer groups were able to answer yes on all of these. The exception was one, and we'll be talking about that example in a moment. But I'm not going to spend a lot of time on this because I know we're running a little over time here. So let's move on to the next slide. This was covered by Frasier as well, using the 100 full-time employee example. For the employer that does not offer coverage or it's not affordable, doesn't meet this minimum value, we take the 100 employees and we get relief for the first 30 and calculate the penalty based on the 70 employees for a total penalty of $140,000. Now, this is a number that would likely be a lot less what it would cost to put in group health plans, but in this case, we see that in the other example, if they did offer it and it wasn't affordable and 20 go to the exchange, they would pay $3,000 per employee and be responsible for 60% or $60,000 on this particular example. Now, what's interesting, I don't know how many of you out there saw the State of the Union back on January 20th, but when the word, 20 employees go to the exchange and receive a subsidy, Obama stated back then that 10 million Americans will get coverage through a government exchange and receive a subsidy. And then if you saw on YouTube, I think it was just 2 days ago, he's now claiming it's about 11 million plus. What's not mentioned, and Frasier, I think you would agree, is that the IRS has a 16-month look-back period to audit the tax credit that is claimed by these 11 million people who are going to get the subsidy. And if you were one of those 11 million and you received a raise or got a bonus, changed jobs, or your family income increased, you are going to owe a portion of that subsidy back if your income differs on your tax return. Next slide. So we have a client that's in manufacturing, actually manufacture furniture, and it's a family-owned business, 85 employees. They've always offered good health coverage, 70% contribution from the employer, and they've been having a tough time because they're competing with China now. They have an older set of workers They, their average age is about 49, and they are, a lot of the employees are, managing their health based on what is being offered by the employer. We know based on utilization reports that there's quite a bit of maintenance drugs, and people are relying on this plan. But the CFO was interested in sending, just doing the calculation to see if it made sense to send them to the exchange to get health care and rather than paying for it themselves. Next slide. Now, in this case, the employer's portion of the cost of the plan was about $350,000, $500,000 if you took in what the employees paid. About 40 employees don't take the coverage because they're on a spouse plan or just decline coverage due to cost. So under this model, we have a total of 85 employees minus our 30 equals 55 times $2,000 in the penalty. It's pretty obvious that the employer can send his employees there and save $110,000. Now, he had made an assumption that most of his employees would be getting a subsidy. But his average salary fell right at that level of about $40,000 to $45,000. They're not highly paid, but the way the rules work, and Frasier talked about the federal poverty level, your subsidies in most states are kicking in, if you're not on Medicaid, at around $11,500, maybe up to $44,000. So the majority of the employees would end up going to the state exchange thinking they were going to get help paying for coverage, and the truth is they would not. And when the employer understood this, he realized that most employees would not, and I think there's a typo there, because very few employees would qualify for the subsidy, very few would actually enroll in the state exchange. So the decision was made that we better keep a group health plan in here because I think a lot of the employees would just go without their seeing doctors, getting their prescriptions, and that would obviously hurt production. So the decision was made to keep the plan. Next slide. Now, Frasier talked a little bit about this. We know there are people on the call right now that have fewer than 50 employees and probably have friends and business associates with small companies. And it's happening quite often where employers with 10, 15 employees or maybe fewer are now considering dropping the group plan and sending their employees to the individual plans in the state that they live and then paying for the coverage. And this is absolutely not allowed by the Department of Labor. And this all sort of came to fruition on November 6, 2014. Now, Frasier mentioned that just yesterday, IRS notice 2015-17 gives 1 extra year to avoid this penalty. Now, we have quite a few law firms we do business with, and I'm going to tell a quick story, and then we'll move on and try to conclude this presentation so we have time for questions. But the law firm had a lot of employees that were on Medicare and spousal plans, and Aetna actually discontinued the group plan because they said they didn't meet participation. And it abandoned about 10 employees that needed a plan, and because we couldn't meet participation, we sent them to the individual market, and they set up a premium reimbursement arrangement. This was back in December of 2013. So of all our employers that had done this, this was the one that had read the law about the $100 a day fine and quickly discontinued this on January 1 this year and is now paying for a group plan, and we had a carrier that allowed it. Let's go to the next slide. So in the second part of this is we had mentioned how do we attract employees and retain them and try to manage costs. This is a slide that, a lot of the large employers, I guess, are lucky if they got an 8% increase per year over the last 10 years. I don't think that's truly could be said for the smaller groups. It's more like 12 or 15%, but it's obvious that the costs are going up. Next slide. So we saw a huge enrollment increase, especially among the 3 to 199 employer groups, into the HDHPs, but we're really calling them HSAs. 58% are in that category have gone to these, or at least they're offering them. Next slide. We know that the HSAs are really making better consumers of everyone. They are now spending their own money and using pre-tax dollars to do it. When the HSA came out, we had a lot of consumers question the numbers that they were, or the claims that they were being hit with and the charges they were receiving. We found that a lot of physicians were caught upcoding and billing for services that did not occur, and it really helped bring the marketplace to a more honest level. And it also helped employees shop around, and we found that an MRI in Greenwich, Connecticut was $1,500. You could save $500 if you went up to Mount Kisco, New York, about 20 miles north. So the HDHPs are working. Next slide. So if you're an employer, you want to start with a strategy on how we can offer our employees more choice and reduce our costs. We're finding that what the trend is now is really to try to bring this onto some kind of a platform to deliver the benefits, to consider a defined contribution, and educate employees through an online marketplace so they can better understand their options. Next slide. We're also hearing a lot about private exchanges. If they're not where you are today, in 2 or 3 years, they probably will be. The private exchange really allows an employer to offer choice, predict their budgets, and reduce the paperwork and errors because it's going to be delivered through an online system similar to what you might do with Amazon. Next slide. This slide is basically just saying that we've got people on the left who don't use health care. They're probably going to be the one who buys the HSA plan. Stay in a low-cost option. The middle tier is someone who wants a decent health plan, but they also need all the dental and all the ancillary benefits because they have a family. And then the last person is someone who's going to see a lot of doctors, probably have a lot of prescriptions, and would be looking for a richer plan. So the basic message here is one size does not fit all. And employers who continue to try to offer one option for simplicity, they're spending more than they really need to because there's a lot of employees who are not going to use it. All right, defined contribution. This is kind of a sample of what your dashboard could look like. Again, it's kind of an Amazon feel where you'll have your choices and you'll know right where you are in the purchasing. You'll buy your core benefits first. In this example, you get a PPO or an HSA, and if you click on through, you'll end up getting your dental, your FSAs, your life insurance and voluntary benefits. This also will eventually lead, if you have a model like this, to non-insurance benefits, voluntary benefits. An HRIS system like this can also track the 60-55 reporting requirements that Frasier had mentioned earlier. And we believe that the defined contribution is really here to stay. You know, as we shift toward this model, many consultants are betting that a technology-empowered consumer experience will be the winning competitive strategy in the future. And it's predicted in 2 to 3 years, employee benefit programs will undergo this dramatic shift to these kind of models. It'll allow the employers to gain control of costs, and the responsibility for buying benefits will shift to the employee. The hardest part is stopping what you are used to doing and actually making the change. So that's it for me. I know we're at 10:55. I think we're only going to have 5 minutes for questions, but we can obviously be reached after this concludes. So I'll turn it back over to Elizabeth, and thank you for your time.
Thank you, Joe, and thank you, Frasier. Again, to ask a question, you may use the question function of the webinar console in the right-hand corner of your screen.
Elizabeth, if I may, while we're waiting for some questions to get queued up, I did want to make sure everybody understood, exactly what Wells Fargo Insurance Services, is. Most people are familiar with Wells Fargo, the bank. We are a wholly owned subsidiary of Wells Fargo and Company, which is the holding company for the bank. We are one of the 10 largest insurance brokerage operations in the country. and provide a lot of property casualty, personal lines, as well as employee benefits, brokerage services and consulting services to their clients, to our clients across the country. And in my role, I'm one of the 2 national practice leaders that provides benefits compliance support services to our sales and service teams that are working directly with our employer clients to try to figure out, all of the nuances of this very complex law.
Great. One question came through. For the defined contribution model, can you have one carrier or multiple? And how do you handle multi-state employee pool?
If you're a very large employer, I would say, the underwriters don't typically want more than one carrier in a group with fewer than 300 or 400 people. So if you're a large group, over 500, the answer is yes. If you're right around 100, you're only going to be allowed to have one carrier, but you could have up to 3, 4, 5 choices for your benefits. Now that's all medical. If it's, you certainly can have a different carrier for medical, a different carrier for ancillary benefits. The list goes on and on.
All right, I don't see any other questions coming through. Oh, here's a follow-up. And for employees in multiple states?
Oh, absolutely. On the defined contribution?
Yes.
Oh, absolutely. Yeah, it can be customized to offer by work location. It'll have the same look and feel, just the names of the carriers change.
Okay.
Looks like we made the hour.
Final call for questions.
And you'll allow if they ask after this closes down, you'll certainly forward anything to us if it's pertinent to Frasier or me.
Yes, for sure.
Yeah, we'll be glad to be of assistance.
Sure.
All right, great. Well, if there are no further questions, this concludes today's presentation. Thank you, everyone, for joining, and thank you again, Joe and Frasier. Have a great day.
You too. Thank you.